Good afternoon, and welcome to this plenary panel session on completing Europe's economic monetary union, which is organized by the European Central Bank. My name is Frank Smets, and I have the pleasure of moderating this panel. Following the outcome of the UK referendum, I think it's become even more important to address some of the challenges that we're facing in our currency union, in our monetary union, and that's really what this panel is about. And there's really two angles that I guess one can take. One is more from a sort of country perspective. How do we ensure that we prevent or avoid the type of divergences that we have seen in the past that led to the sovereign and banking debt crisis? And how can we make our economies more resilient in responding to these symmetric developments? And the second angle is more an aggregate angle. In an environment, current environment of relatively low growth and very low interest rates are close to the effective lower bound. How can we ensure that other policies than the monetary policy can help restoring growth, increasing the equilibrium real interest rate, and thereby also help monetary policy maintain price stability? So to address these issues, we have an excellent panel. There's Benoît Cœuré, who's a member of the executive board of the ECB, responsible for market operations and international European relations. Then we have Philip Lane, who crossed the bridge from academia to policy and is currently the governor of the Central Bank of Ireland. And then we have Guido Tabellini, who is a professor at Bocconi University and who has also been recently involved in some of the thinking within CEPR about how to reboot the euro area economy. And there is the VoxEU book coordinated by Giavazzi and Baldwin, where Guido also participated in. So with this panel, I think we're off to a very good debate for the next, well, a little less than an hour. The way we've organized is that each panelist will make some preliminary remarks for about 10 minutes, and then we'll open up the debate for questions and discussion amongst the panelists. So with this, I give the floor to Benoît.
Thank you, Frank, and good afternoon to all of you, and bon appétit to all of you who are eating their lunch boxes. We don't have that luck here, but I guess it will come later, depending on our performance. In my initial remarks, I would like to focus on something which might sound quite far away from monetary policy, which is structural reforms, and make the point that we a little bit more focus on the way we do it, the way we sequence it, and the way it interacts with monetary policy and fiscal policy also will make EMU work better. So my punchline here will be that a more focus on structural reforms is a first step towards a better functioning EMU. But I guess the first question that comes to mind when you discuss structural reforms is, why should central banks care at all about structural reforms? After all, it's not within our remit. We've not been appointed to do that. This is within the remit of elected politicians and social forces more generally, social partners and the like. So why should we care? And one first very general reason is that even though monetary policy is clearly independent, the way we do it, the way we design it depends on our environment. So we cannot ignore the actions taken by other stakeholders, in particular by governments. So to put it simply, whichever measures we decide to bring inflation back to below 2%, but close to 2% in the medium term, which is our mandate. These measures will be more or less efficient depending on the way the economy functions, and then it retroacts on the way we design the measures. Maybe to go a little bit more deeply into that argument, structural reforms are instrumental both for the level of growth in the Eurozone and for the dispersion of growth, the convergence between Eurozone economies. Convergence, a certain degree of convergence between Eurozone economies is a prerequisite for the effectiveness of our monetary policy. And we've seen that many of the measures we've designed since 2007 have been needed because of divergence, fragmentation, etc. So less fragmentation, more convergence is useful for us also in our monetary policy mandate. I would also argue that lifting the growth potential of Europe, the long-term growth potential of Europe, is a prerequisite for recreating trust in the European project. And this is not only about trust of citizens into the European project. They want to see unemployment going down. They want to see growth being lifted up. And that's what will make them confident that the European project is worth it. But that's also about confidence or trust between participating governments. And there is obviously a lack of such confidence today. So a higher rate of long-term growth, more convergence between economies are both prerequisites for taking further steps into completing EMU, which is what basically Philippe and Guido will discuss. But my point here is that if we don't see more structural reforms in Europe, we won't recreate this kind of trust that will allow government to take further steps into, say, new risk-sharing mechanisms, or say, fiscal union, which I think is useful. So I'm not saying that this is not useful. This is useful. This will be discussed. But what I'm saying here is that as a first step, we need to recreate trust in the capacity of our economies to converge towards each other. And this is about structural reforms. So now, and very shortly, going into the substance of it, where do we stand in terms of structural reforms in Europe? Starting with the fact, the European Commission estimates potential growth in the Eurozone to be around, say, 1% in 2016, 2017, which is much lower than the US. And also the dispersion of structural performance is quite wide in the Eurozone. If you look at unemployment rates, for instance, it ranges between 5% in Germany and 25% in Greece. And if you look at youth unemployment, it's twice as much. So it's, again, both about the level and about the dispersion. And the starting point, the place we're in today is quite bleak, to say the least. It's not very positive. This shows that the way the economic structures in our monetary union work today are not up to the task. They are not fit for the purpose of sustaining a single currency. They are not generating the amount of convergence and growth that would be needed to make the single currency work well. So when you want to look further into the reasons for this bleak performance in structural terms, there are, of course, many reasons. Demography is one of the reasons. There are many structural reasons why growth is low and growth is uneven across EMU members. But it has a lot to do, in my view, with the lackluster performance of labor markets and capital markets, and the lack of integration and the too many hurdles that oppose the circulation of labor and circulation of capital in EMU. So labor market mobility is low, as we know. Even capital mobility is de facto low. It's de jure perfect. It's de facto quite low. It doesn't have the right composition. It's mostly about bank flows, as we know, short-term flows, not enough about equity, cross-border equity flows. And that in turn is an obstacle to generating higher total factor productivity growth rates. So basically the starting point is that markets could and should do a better job in allocating labor and allocating capital across the participating economies. So A lot is being done about it, and Frank, in his introduction, mentioned actions taken at country level, and a lot of countries have taken action both to improve the functioning of labor markets and of capital markets. But taking a bird's eye view of all of what is being done and has been done since the start of the crisis, I would like to argue that there are maybe 3 principles which have been on which we should put more emphasis looking forward, and I will be very short. The first principle is the need for a comprehensive approach to structural reforms. After the crisis, reforms, in particular reforms in those countries that have been hit by the crisis, have been too often focused on labor markets, and even more narrowly, in an even more narrow way, focused on labor cost, and not enough on product markets. And we know that a more comprehensive approach to reforming both product markets and labor markets can deliver a much better performance. So we know the reasons, obviously. Product market, service market reforms encounter a lot of resistance from vested interests. So the political bar is very high. But that's not a reason not to address it. And there hasn't been that much emphasis in European discussions on how to have it right, how to engineer this kind of sequencing of labor markets and product markets reforms. The second principle is about mitigating the short-term costs. So that's a big academic discussion, which is well known. Some reforms have a negative short-term cost. Some reforms presumably can have a positive short-term impact. All reforms, if they are well designed, have a positive long-term impact. But some of the short-term negative impacts have to be mitigated. So again, here the sequence matters a lot. And in many places, governments have focused too much on labor market and too narrowly on labor market reform without focusing enough on product market reform. And so having the right sequence of first opening product markets and service markets and then labor markets can already go a long way towards mitigating the short-term cost. In particular, in program countries, I mean, I can do a little bit of self-criticism also as the ECB being a member of the Troika. We've focused a lot on labor market reforms in program countries, meaning that wages have gone down quite a lot in countries under a program. We haven't focused that much on product markets, meaning that the burden of the adjustment to the crisis has been unfair. It has been borne primarily by the workers and not enough by the owner of companies, in particular in the service sector. And Greece is a case in point. So here the sequence also can be instrumental in delivering a better performance. And second, you need some mitigating or accompanying macro policies. So here, obviously, the space is limited. There is not much space for fiscal policy today to mitigate or to accompany structural reforms, but still, there are places where there is space, where there is policy space in terms of fiscal policy, and the ECB, as well as the European Commission, has been public saying that this space could be better used. There are also many places where there is no fiscal space, and in those places, there is no point in trying to invent a fiscal space that you don't have, because then it will come back with a vengeance when it turns out that debt is too high. And second, the composition of fiscal policy matters a lot. The growth friendliness of taxes and expenditures matters a lot. And the discussion on the implementation of the Stability and Growth Pact has been a lot focused on the math of it, the numerical aspects of it, and not enough on the qualitative aspects of it. Even though it's possible, it's there. But in all countries, there is room to improve the growth friendliness of fiscal policy and to make it a support to structural reform in a more effective way. And the third principle, and I will be done, is about looking beyond reform in individual member states and taking a Eurozone view. And that also maybe has been lacking in the crisis. Lots of countries have focused in a kind of partial equilibrium way on their own economic performance, in particular on the cost side of it. So this has been internal devaluation, for instance, in a number of countries, which is fine individually, but it's not fine collectively, because it's a zero-sum game, essentially. It's first a zero-sum gain within Europe, and it's also a zero-sum game with the rest of the world. And you cannot imagine that Europe can grow its way out of the crisis by generating an enormous current account surplus at the expense of aggregate demand in the rest of the world. That's not possible. So here you need a little bit more of a collective approach. And what I would suggest here is that the approach would be a little bit less about competitiveness at country level, but more about productivity at Eurozone level. So more TFP and less about cost cutting at country level. So a more cooperative approach. The conclusion here is a lot can be done to improve the functioning of EMU. There are important discussions to be held in the fiscal field and in the field of moving towards the fiscal union. And I'm not dismissing these discussions, but my point here is that if we are not in a position to generate more growth and to have more convergence across the participating economies, these discussions will simply not take place. And I stop here.
Thank you very much, Benoît. So then we have Philip.
It just shows you how long I've been, even 7 months at academia, and I've forgotten how to use PowerPoint. Okay, so what I'm going to do in my 10 minutes is to take a different angle on this question, which is essentially from a national perspective, and coming from a national central bank, this is maybe natural, and ask, does being a member of the euro area hinder the attainment of macro-financial stability at the national level? How does it help? How does it hinder achieving stability? So at one level, you might argue, why should the monetary regime matter all that much? So we know from a long literature in international economics that the exchange rate regime seems to matter for nothing apart from the volatility of exchange rates. So it's very hard to run any kind of study on economic performance where you see any difference across pegs, flex with exchange rates, and so on. So at one level, you might argue maybe the issue about being in a monetary union or not doesn't matter too much for stability. And then you might also argue from a welfare point of view, why is volatility important? Should we not focus on the long-term issues like long-term TFP and so on? But I think there's plenty of reasons to believe there is a connection between volatility and long-term performance. There's all sorts of hysteresis mechanisms you could look at. And I think we know from the labour market and also from the financial system, it's very hard to do reallocations. So any kind of a sectoral misallocation, so having a boom in the non-traded sector, which then has to be unwound to allow the export sector to grow, to have a volatility in the mix between private and public sectors, and even within investment between construction, the structures type investment versus equipment. All of these are not so easy to correct. And also there are intertemporal misallocations. So if you have a consumption boom, it's really hard to make the adjustment from a high rate of consumption to a lower level of spending, even if GDP is unaffected. And anyway, we might have had this debate ex ante, but the counterfactual question about were there other ways to manage the credit boom 03 to 07 and the post-08 crisis phase, I think is very important. So a lot of what I'm going to say today, actually, my views are formed pretty much before I switched over towards the central bank. So what I'm going to talk about today is largely also found in a paper I wrote for this Bank of Portugal conference, which is just published by Oxford University Press, and my paper, the draft versions in the CPR discussion paper series. So the reasons to believe that monetary union may add to the challenges in terms of delivering stability is essentially, once you have a single currency, maybe there's a greater risk, given the absence of currency risk, maybe there's a greater risk of amplification dynamics. For example, a growing economy may be able to sustain a bigger credit boom by drawing in debt capital from the rest of the system. And of course, we saw this in the mid-2000s. On the other hand, you could argue, well, maybe eliminating currencies also eliminates some types of financial shocks. So this is the idea that a monetary union could be a zone of financial stability because you've eliminated speculative shocks from the currency markets. And on top of that, you have the fact that with a common central bank, there's a buffer role of Eurosystem liquidity. So in 2010, the Eurosystem liquidity into Ireland was 55% of GDP. So in the absence of that liquidity, the play out of the crisis would have been quite different, with pros and cons to that. There's also the argument that regardless of the exchange rate regime, maybe there are sufficient national policy frameworks available so that any kind of volatility at the macro level can be managed. And this goes back to the issue, what is the balance between national policies versus needing new area-wide level policies such as federal fiscal frameworks, risk sharing and so on. So, what I want to primarily discuss is what is already available at the national level, which is essentially macroprudential policies and also national fiscal policies. On top of that, you could argue that it's not possible to eliminate volatility or crisis risk entirely. So a complementary set of policies is to make the system more resilient. So whether this is reforming the financial system, reforming the labour market, and importantly also reforming the legal system. I think my experience in central banking is a lot of time in the end it's going to be legal questions about how does the legal system handle non-performing loans? Is the legal system good at dealing with insolvencies and so on? Now, in the paper I mentioned, I did an empirical study asking, well, the world was dealing with volatility in the mid-2000s and also post-crisis. So did the members of the euro area have a more volatile experience than other advanced countries? Because we know there's a global financial cycle. We know there's work by Hélène Ray, for example, about essentially no matter what your exchange rate regime, it's difficult to deliver stability in a world of financial globalization. But anyway, what I found is maybe there's fewer differences than you might think between the euro area and the other advanced economies. But there is some evidence that those in the euro area have greater procyclicality, so amplifying dynamics in inflation, in domestic credit, and in net portfolio flows, the type of debt flows Benoît was mentioning earlier on. And then I think the other important empirical evidence is it's very costly to experience a sudden stop. So the larger current account imbalances we saw in the mid-2000s, if they had unwound very gradually in soft landings, maybe they would have been okay. But when you get a sudden stop event, it's just this massive declines in consumption, big declines in GDP, a lot of increase in unemployment. They've been very costly. And so any policies that can reduce the risk of that kind of event again is worth looking at. So just everyone knows these types of pictures, basically saying you can look at euro area dynamics, for example, for credit growth, which obviously credit grew in the mid-2000s and not so much since the crisis. But the bigger story is the dispersion. So the shaded area here gives the interquartile range between the 25th and 75th percentile of member countries. And you see this gigantic divergence in the mid-2000s and also divergence now. You get a similar story with the current account and with the net international investment position. And again, a common phrase is legacy issues. So even though current account imbalances have narrowed, by and large, the stocks of net external debt have not particularly come in. So the dispersion in net IIPs is as big as ever. Okay, so what kind of national policies are available? And Guido's going to talk about fiscal, so I'll say less about that beyond saying, of course, there's a role for counter-cyclical policy at the national level. so long as it's anchored in the long term in order to provide the fiscal space to engage in counter-cyclical policy. But in terms of macroprudential regulation, there's been a lot of progress in the last number of years to set this up. Because in the mid-2000s, there was a lot of discussion about this, but there were concerns about leakages. So if you regulate the banks, that non-bank entities would take over credit intermediation. If you regulate domestic entities, then cross-border intermediation would just replace the domestic entities. So essentially, in the setup now with the European Systemic Risk Board, with concepts of reciprocity, with concepts of topping up at the ECB level if needed, that maybe there's more scope now to actually run a proper macroprudential policy. And you can think about borrower-based measures and all sorts of counter-cyclical capital policies. Now, having said that, and in terms of exhorting the academic world, the evidence base is thin. There's not a lot of historical evidence in Europe, more from Asia, not a lot in Europe about whether these work well, whether they're effective. And also at the modeling level, essentially looking at DSG models and other models to work out what kind of calibrations should be applied. And just let me emphasize, and I think an important point, is it's probably good to be two-handed about this. So there's a very interesting paper by Philippe Martin and Thomas Philippon, which essentially looks at models of small open economies in a monetary union. And the point here is, if you have both macroprudential policy and counter-cyclical fiscal policy, they are complementary, i.e., if you use macroprudential policy, the type of counter-cyclical fiscal policy you need to use is not insanely impossible. So Olivier Blanchard, used to say essentially to have the kind of fiscal surpluses to cool down the Spanish economy or the Irish economy mid-2000s would have been politically infeasible. But if you are also using counter-cyclical macroprudential measures, then they can work together. So I suppose the message I'm trying to give here is maybe on top of looking at fiscal union type measures, maybe on top of trying to create convergence in terms of more similar economic performance, so asymmetries and national policies don't need to come into play. Maybe there is indeed a role for national policies in making the euro area more cohesive. And I guess that's what I do on a day-to-day basis, or try to do. And then maybe my last point is, in terms of system resilience, legal system, it's difficult to overstate the importance of having a well-working legal system that handles insolvencies, handles recovery of collateral and commercial disputes. Let me maybe also, this famous doom loop between sovereigns and banks. Elements of that are being addressed, but in the end, I think more needs to be done. And Frank, how many minutes? Am I over time already? Or probably am? I am. So maybe I won't say too much, because you can read all sorts of literature about ESBs and other ideas. So I think I'll just stop there. Okay, thank you.
Okay, so thank you for having invited me. So I want to discuss fiscal union, perhaps the most difficult and arguably the most important way of completing the Eurozone. And in particular, I want to discuss two questions. First, what should be the goals and priorities for a common fiscal policy? And second, what should be the main principles around which a fiscal union can be built? Let me emphasize two caveats. Of course, I'm fully aware that the fiscal union is not politically feasible now. This is not a good reason not to discuss it, however. I think a task of economists is also to prepare ideas for when these reforms become feasible, and also by discussing it, perhaps feasibility will come forward. Second, I think even in the very long run, any fiscal union for the Eurozone should be built on very minimalist criteria. There is an obvious starking difference between the European Union and the US when the US became a confederation. At that time, the size of government in US states was very small. Now we have arguably two large governments. So most of the fiscal capacities will have to remain national, even in the very long run, and the criteria should really be for the essential things that cannot be done at the national level. What are then the main priorities? I think the following two. The first one should be pretty uncontroversial. We need a tool for aggregate demand management. This was emphasized also in the Five President report. There are essentially two large reasons for why this is needed. First, we now understand that we can be at the zero lower bound of interest rates much more frequently than we once thought. And when we are there, we need fiscal policy to help. Monetary policy becomes almost powerless. And second, fiscal policy coordination will not be a substitute. First, because it's difficult to achieve coordination, and second, even if we could achieve coordination, it's not the right tool, because think of the current circumstances. We may want to achieve, for instance, a larger average fiscal deficit or a smaller surplus in Europe. We could do this by asking Germany to run a smaller surplus or a larger deficit, but this will not be necessarily the right tool to help Southern Europe, who lacks demand. So for this, really need a European fiscal policy, not just to coordinate national fiscal policies. The second priority for building a fiscal union is much more controversial. It was explicitly ruled out in the Five President report, but I nevertheless think that it is an important priority, and that is to rely on common fiscal resources for management of large financial crises. And I think here there are several arguments too to defend this position. First, there continues to be the risk of sudden stop. And if you have a sudden stop, then there is inevitably a risk of exit from the single currency. Here, maybe I depart a little bit from the statements that Benoît made. I agree with him about the importance of structural reforms. Anybody must agree. But to regard convergence as a prerequisite for having a fiscal union may imply that the fiscal union will never come, because one can argue that because of the risk of sudden stops, some parts of the Eurozone may be at a systematic disadvantage and will never be able to converge with the rest of the Union, because inevitably a sudden stop also carries some currency risk, a risk of exit, and this, of course, makes everything more complicated. Second, even aside from the sovereign debt crisis, the size of the financial sectors in most member states is several multiples of domestic GDP. So national resources may not be enough. Of course, we have the ESM to deal with these problems, but one can argue that the ESM may not be having enough resources at its disposal, and in any event, it's bogged down by a decision-making procedure that gives vetoes to some national parliaments. Let me emphasize finally that I do not regard as a priority for fiscal union, instead, to build systems like European unemployment insurance or systems for dealing with individual risks. First, we have national welfare states who can perform that function and work well, as long as member states can retain access to financial markets. And second, there are obvious, very critical difficulties in designing these systems while regulation of labor market remains at the national level. So essentially, I think a fiscal union is needed to ensure against very large systemic shocks, and it's primarily needed to ensure governments rather than individuals. Now, let me then turn to the principles on how to do it. essentially all these, the principles relies on a key idea, which is not new, has been emphasized in other studies by the CPR report, to which Philip Lane was a contributor, a note by Angel Ubide of the Peterson Institute in Washington. And these contributions essentially emphasize the idea that the EU is a supranational institution, and as such, it enjoys more commitment capacity than national legislatures, because it can impose sanctions on costs on countries that renege on these commitments. And so the idea is to exploit this additional commitment that the EU has to build a borrowing capacity, essentially by using this commitment to pledge government revenue far into the future, and if the commitment is credible enough, you do not need to pledge large amounts of government revenues. So building on this idea, in particular, Angel Ubide has proposed the following scheme, that member states would agree, of course this would have to be unanimously and a very strong agreement, to transfer every year to the Eurozone up to a given percentage of its own GDP, say 1–2%, for a long period of time, say 30 years, if they are asked to do so by the competent EU institution. Backed by this pledge, the Eurozone can then issue its own debt, and initially, this debt needs to be liquid, so it needs to achieve a large enough size, maybe 5–10% of GDP. And so in building this initial debt, you would force member states to retire their own national debt. So the proceeds of the Eurozone debt would be passed on to member states, who would be required to use the proceeds to retire their own national debt to avoid accumulating an excessive amount of overall debt. And then once the debt market is liquid enough, you can then use the Eurozone debt for stabilization purposes or for crisis management, rebating the proceeds of the debt issue at the Eurozone level to member states who would be free to use them for cutting taxes or for financing public investment or however they wish. Of course, there would have to be a limit to how much debt can be issued, consistent with the pledge by the member states. 2 words about the governance. Here I'm borrowing from ideas in Sapir and Wolf, who should be in charge of issuing these debts and governing these decisions. The natural answer is a transformed ESM. We can call it a European Fiscal Institute, thinking about the precursor of the ECB. The governance of this European Fiscal Institute would naturally resemble that of the ECB, namely you would have to have an executive committee with important weight on its decision procedures, and the governing council. The governing council, we already have it in the ESM, it's the Eurogroup. It would be natural to preserve that feature. Policy decisions would have to be by majority rule in the routine decisions, and this new institution would have to be accountable to the European Parliament rather than to national parliaments like the ESM now, particularly for the main decisions. Second, it would be natural, once you have this new institution, to give it also veto rights over the national budgets, to make sure that the stability bonds do not accumulate over unsustainable national debts. And so these veto rights could be exercised in specific procedures or according to specific circumstances. Let me close just by mentioning some obvious difficulties in this kind of arrangement. One difficulty is that you need a very long-run commitment for that to be credible. Now, logically, I don't regard this, however, as a problem, because in building the single currency, we already undertook a very long-run and irreversible commitment. Otherwise, we just have a fixed exchange rate. So, having a long-run commitment on fiscal policy seems perfectly consistent with the decisions that have already been taken. A second, more tricky issue has to do with what rating this stability bonds would be able to achieve, because, of course, member states could default on their obligations to the Eurozone, and so to preserve a very high rating, it is conceivable, I'm not an expert here, that one may need to ask for a more open-ended commitment. So the Eurozone institution may be required in specific circumstances and according to specific procedures to force member states to transfer a bigger amount of resources than initially pledged, or the pledge has to be large enough not just to service the debt, but also to meet the unexpected needs in the event of other defaulting countries. So here there is a trade-off between achieving higher rating and preserving national sovereignty. You cannot have both. If you want a very high rating, you need to lose more national sovereignty. Finally, there is an obvious political issue. The scheme that I described would not be a transfer union except in the event of crisis. So if you rule out crisis management, this entails no transfer between countries because all countries would contribute the same percentage of GDP to service the stability bonds. Nevertheless, it's clear that the benefits of this scheme are asymmetric. They accrue more to the weaker member states who have less room for maneuver in their budget and who are more likely to be subject to financial crisis. Nevertheless, you can also envisage an asymmetry in the loss of sovereignty, because if indeed the new institution can veto national budgets in the event in which the national debts are unsustainable, it's foreseeable that these vetoes will interfere much more frequently with the decisions of the weaker member states. So it's true the benefits are asymmetric, but the loss of sovereignty is also likely to be also asymmetric. Let me stop here.
Thank you very much. Thank you very much, Guido. To react to each other's comments, that we first collect 3 questions, and then I'll go back to the panelists. We've covered quite a bit of ground. There's at least 3 themes that maybe I would highlight. The first one is, what is the right balance? If I look across the presentations, what's the right balance between national policies and national adjustment mechanisms and more European approaches and European policies in addressing some of these issues? A second theme is that we need a comprehensive approach, whether it's within the structural reforms or across different policies, so we don't really have the luxury to forget about some of those. And the third one, which came out a number of times, is a sequencing. Again, whether it's within structural reforms or across the unions, should we have first fiscal union and then economic union, or the reverse, which is really what was behind the 5 Presidents report. So with this, I'm just looking around, see whether there are any questions, please.
So my name is Elliot Tokac from the BIS in Switzerland. And the question would be about structural reforms. So I think it's all nice if structural reforms work out and growth picks up and becomes much stronger than what it is now in a sustainable way. What if not? So what are the options left if growth remains weak, anemic, and what central banks can do? What are the options that you see?
Thank you for very interesting presentations. I just wondered if the panel would like to reflect on, when they look at Southern Europe and some of the unemployment in Southern Europe and the rise of extreme parties across Europe, do they ever worry that monetary union is maybe part of the problem rather than part of the solution?
Is there a third one? No? Well, if not, then let me go back. Sorry, do I see? Go ahead, sorry.
Hello, Kemal Osan, University of St. Andrews. Do you have any plan about the non-performing loans that's taking place, like this problem taking place in the Southern Eurozone, especially Italy? Like, it is related with the fiscal union, I think, if there will be some risk sharing later on.
Benoît, you want to?
Yeah. So to the first question, what if growth does not pick up? I mean, that's a very good question. We have to consider it. It's clearly part of our job to consider all scenarios. Well, first, growth is picking up. So certainly not up to the levels we would like to see or up to the levels we've seen in the past. And as I said, potential growth is clearly much below what it used to be before the great financial crisis. But yet it is picking up. So let's not discuss under the assumption that there is no growth in the Eurozone. There is a recovery path. It's not as good as we would like, but it's taking place and growth will continue to accelerate. I guess most of us would agree that long-term potential growth is not something that central banks can act on. We can contribute to some extent. I know that there can be some hysteresis in some markets. So, I mean, good short-term policies certainly are a contribution to a sustained long-term growth, but most of it is about TFP, labor market participation, if not demography, which is another discussion. So what if that doesn't take place? That is a deep constitutional discussion, I would say. We have a mandate, the ECB is independent, has a mandate to bring inflation back to 2%, close to 2%, below 2%, whatever the environment, in a sense. So the less happens on that front, the more we would have to do. So that's a case of, not of what we used to call fiscal dominance, strictly speaking. I would call it structural dominance, which may be a new concept. That if nothing takes place on that side, then the central bank may have to do more. But then we would do more, because we are independent and because we have a narrow mandate given by the EU treaty. So the only message here is, if there is not much taking place on the structural reform front, if there is not much taking place on the fiscal policy front for what can be done, then the ECB would have to do more. This would come with, presumably, with side consequences, because there is no free lunch. So anything we do also comes with side consequences, possible future risks for financial stability and the like. So far, we've mitigated, managed, curbed those risks, but the more we have to do, the more the side effects would materialize. So that's a message for politicians, I guess, not for us.
So one way to think about some of those questions is to make a division between economic challenges that basically many countries face, whether they're in the euro area or not. So issues about low growth, the prospects for future productivity and so on. I mean, we know that's a debate among all advanced economies. But I think going back to Benoît's presentation, I mean, the very basic point to note is, regardless of where you think the frontier is going, the fact that I think there's a big accumulation of evidence, whether it's from the OECD or the IMF or other sources, that over some horizon, so okay, I wouldn't claim to guarantee it's going to happen over a 1 to 3 year horizon, but over some horizon, reforms that bring various countries that are far below the frontier towards the frontier would act to boost growth. I would also say that within Europe, the fact that the deleveraging process is probably behind where it is in the US does mean there's a clear extra reason why the growth recovery is positive, but still not at full speed. But as deleveraging continues, then one countervailing factor will be removed. The question about whether monetary union is the problem, or a part of the solution. Again, I think my presentation tried to point out it's a bit of both. There's clear, and when I did that study last year for the Bank of Portugal book, I did try to be fairly open-minded about it, and there is evidence that I've been part of the monetary union backward-looking. So as the monetary union was constituted, if you like, up to the crisis, did lead to some destabilizing dynamics along some fronts. But what I also tried to point out is that the reforms that have taken place since then in terms of the macroprudential framework, banking union, and more reforms I think that have yet to occur, can make monetary union sustainable, and that would also be reinforced by the type of policies that Guido outlined. So ultimately I don't think we can argue that prosperity and living standards turns on monetary arrangements. There's no ground evidence from world history that monetary arrangements are so critical to long-term prosperity. So I wouldn't overstate it. And then the interesting question about NPLs and risk sharing. There's interesting internal to Italy, issues now about the role of private sector money versus public sector money, the role of tranching, the role of first loss. There's all sorts of interesting risk-sharing schemes because it's unknown how much you can recover from these NPLs. So I do think the design issues there are very interesting, and also the scope has to be there for some cross-border element. The only point I would point out is attitudes to creditors seem to vary according to whether they are domestic creditors or foreign creditors. I was reading something on the flight over this morning about Eastern Europe, and it's clear that in those countries where the banks are foreign owned, you're going to have governments take a different policy than when banks are domestically owned. More generally, when you sell NPLs to non-banks, so vulture funds, private equity funds, and so on, the political economy of attitudes towards those funds greatly differ according to where these investors live. So there are kind of limits to cross-border risk sharing coming from the fact that it's the identity of the debtor and the creditor does make a difference when politics is local.
Let me discuss two questions, the first and the last. So what if growth does not pick up? I think I would add one big concern, and that is a political concern. I think the issue is not only what can the ECB do, but whether the Eurozone will remain intact if growth doesn't pick up. I think that's a very big question. If you hold an election now in Italy, probably the party that is favored in the polls is the Five-Star Movement. And the Five-Star Movement has announced that it wants to hold a referendum which would not be binding. It would be a consulting referendum on whether Italy should remain on the Eurozone. So if growth does not pick up in the foreseeable future, the question is whether there will remain support for the European project within Europe, maybe not just in the weaker member states. And that's, I think, an argument, again, about worrying on the sequencing, not just from an economic point of view, but from a political point of view. On the last issue on non-performing loans, I think in part it's related to the low growth environment. It's just a consequence of the low growth environment. I'm not a big expert of the numbers, but my understanding is that the size of non-performing loans is large by any measure, but it's not something which cannot be tackled. We're talking about 4 or 5% of GDP in terms of what is needed to fix the problem, so it would not sink Italy. It would not sink probably the Italian banking system, or most likely the Italian banking system. The issue is that it is a drag on the recovery of the Italian economy. Technically, the way to deal with the problem is not obscure. It's been done in other European countries before. You need to put this 4 or 5% of GDP into the banking system, and you don't find private investors willing to do it. So this has to come from the public debt, one way or another. And this is not being done for political reasons, because the European rules are making it harder to do so, because the burden sharing or the bail-in rules raise the political cost of addressing the problem. But in the event of a transforming reform like the one I discussed, I think since the problem is manageable, it would be managed, I think.
So we have time for a few more questions, given that we started like 5 minutes late. Nobody? Please, back.
Oreste Tristani, European Central Bank. I had a question for, I had a question for Guido Tabellini. It's actually two smaller questions about the proposal. So one is that he highlighted that there would need to be, of course, debt limits also for the Eurozone, the common Eurozone debt. And I was wondering, without going into any details, in which sense he sees these limits as being qualitatively different from the ones that are already in the Stability and Growth Pact, for example, or to what extent this is ultimately a quantitative question, the fact that allowing for larger deviations from the current limits of the Stability and Growth Pact under the new system. And the second question was exactly with this concern of fixing the growth problem today. I was wondering whether he has any ideas about the transition path towards this new regime, which he described as possibly a more medium or longer term regime.
So I'm not sure I heard everything well, but so the size of the debt limit that was proposed by Angela Bide in his paper, if I remember correctly, was 25% of GDP, 20-25% of GDP. So that's the order of magnitude about which these proposals have stressed. One question is it credible that this proposal will be respected, and maybe it will not be enforceable? But I would emphasize here that the institution that manages this debt would be a very technical institution. So the kind of political pressure to exceed the debt target would be very different than the one to which national member states would be subject. I don't know whether I answered your question. On the transition phase, I think the transition phase here, the purpose of the transition phase would only be, or mainly be, to make sure that the instrument is liquid enough. I imagine, I'm not an expert on this, but I imagine that having 10% of GDP would be having a debt market that is liquid enough. And so you would need the transition phase to achieve this size. How quickly can you go there really depends on how quickly can you retire 10% of domestic national debt from the national debt markets. Probably not very long, so the transition need not be long, I think.
Maybe two very short and kind of very general remarks following the discussion. First, there is one very important dimension of Guido's presentation which hasn't been discussed so much, but which I think deserves a lot of attention, which is the governance part of it, or the institutional part of it. So who should be in charge of fiscal union? And the proposal here was the European Fiscal Institute, I mean, call it how you want to call it, which would be an institution. I think that's a very important point. If you look at how EMU works today, you have different building blocks which fit each other. They're all needed, they're all complementary, and they work in very different ways. So the governance of the different parts of EMU are not congruent to each other. They are not consistent with each other. So we have monetary union, which is managed by the ECB, a strong single institution. You may like or not like what we're doing, but we're doing it. So when something happens, we get our act together and we're doing it. Fiscal union, as it stands today, is managed in a very different way. It's at best by qualified majority. The ESM works by near unanimity under the control of national parliaments, not the European Parliament, etc. So at some point, you need to put some consistency. Fiscal stability is a key underpinning of price stability. So the governance and the political underpinnings, the political legitimacy underlying the fiscal dimension should be consistent with what we're doing on the monetary policy side, and today it's not consistent. So it's just not reasonable to manage the fiscal part of a monetary union, trading horses all night in a room in Brussels. That's not working, and we've seen it's not working. So at some point we need to move to institutions, and that's one possible proposal.
In that, then it's my pleasure to sort of close the panel and particularly thank the panelists for their contributions. I hope some of the discussions give some inspiration for the research that all of you will be doing in the coming years. Thank you.